Welcome to the Deep Dive. We take your sources, dig deep, and pull out the most important nuggets of knowledge and insight. Today, we're diving into something really quite compelling, the 2007 annual report from Giverny Capital Inc. And this isn't just about the numbers. It's a real window into how a firm navigated a very challenging year. Lots of timeless wisdom in here about investment philosophy, market resilience, our mission to pull out those key insights, maybe some surprising facts too. This report, it even has Pascal Grandmason's glass artwork on the cover, which they said embodies transparency. That's a core value for them. So we'll look at their tough year, their core beliefs, some specific business insights, and the big lessons they learned. Okay, let's get started. Looking at those 2007 numbers, well, they seem pretty difficult on the surface. What were Giverny Capital's returns that year, and how did they actually stack up against their benchmark?
Yeah, you're right. At first glance, 2007 looks, well, tough for them. Giverny Capital's portfolio reported a return of negative 14.4%. Their weighted benchmark was negative 12.0%. So that gives you an added value of minus 2.4%. But here's the really crucial part. Both of those returns, they include a big hit, a 14.1% loss just from the Canadian currency moving against them.
Okay. So strip that out, and what does it look like?
If you take out that currency effect, Giverny Capital's actual investment return for 2007 was roughly negative 0.3%, almost flat.
Wow. So the headline number looks bad, but the underlying performance ex-currency was basically holding steady.
Exactly. It really speaks to their core approach, even when the markets were, difficult. And what's really insightful is how they immediately put that tough year into a much wider long-term context. So we look back since they started. How has their performance been overall? And what are those ambitious long-term goals they talk about?
Yeah, what's the big picture?
Well, since they began, that's July 1st, 1993, Giverny's annual compounded return is pretty impressive. It's 15.4%. Compare that to their index group benchmark, which was 8.6% over the same period.
Big difference.
Huge. And if you again take out that Canadian currency appreciation effect, their portfolio return jumps to 17.4% versus 10.5% for the indexes. Their long-term aim is quite clear. They want to maintain an annual return that's 5% higher than the indexes. So they're targeting, say, 12 to 14% if the general stock market achieves maybe 7 to 9%.
That long-term view really seems central. So when they do face disappointing results, like in 2007, what's the core investment philosophy that keeps them on track? They even said they were going through a rough phase and promised transparency. What does that actually mean for how they invest?
It means, fundamentally, they think of themselves as owners of the businesses they invest in. They're not just, trading stock certificates.
Right, owners.
Exactly. Their entire focus is on studying the growth in what Warren Buffett famously termed owner's earnings. They look at the long-term prospects of the companies. They try to tune out the daily market noise, the fluctuations. And they go a step further. They actually submit an annual table showing the growth of what they calculate as intrinsic value. For them, that's measured by those owners' earnings plus their average dividend rate, which is usually around 1%.
So they have their own specific way of measuring the real value separate from the stock price.
Precisely. It's a core differentiator. How they assess true business worth, not just the market's mood swings. And maybe stepping back for a second, how did Giverny's 2007 experience fit into the wider economic picture that year? It was a pretty dramatic time. What were the key features of that financial crisis they pointed out? How did it hit the market overall?
Yeah, what was the context they saw?
Well, they observed the crisis, starting with that big drop in U.S. residential construction. That was followed pretty quickly by huge losses tied to subprime loans. Remember all that?
Oh, yeah. Hard to forget.
And on top of that, you had this breathtaking raise in the price of oil, which really squeezed consumers. They noted that by mid-January 2008, stock markets around the world had dropped on average 20%. That's bear market territory. And of course, economic growth forecasts, U.S., Europe, Canada, they were all being revised downwards. This is a gloomy picture.
So given that really turbulent backdrop, how did Giverny respond? You mentioned their long-term view, but this wasn't their first crisis, was it? Didn't they even quote themselves from a previous crisis?
They did. Their history shows they've navigated storms before. They explicitly said, we've been there before.
Yeah.
They referenced surviving the 2000-2002 tech crash.
The dot-com bust, yeah.
Right. And also the market plunge of over 20% during the 1998 Asian crisis. And what they found looking back was that these crises consistently created lots of bargains, opportunities. These downturns actually led to some of their best long-term investments.
Like what? Any examples?
Yeah, they mentioned JDS Fattel, which they sold for a big profit back in '99. The Templeton Dragon Fund, Bed Bath & Beyond. And Fastenal, that one went up a massive 700% for them over 9 years.
700%. Wow. And what about that quote from their old report?
Ah, yes, from their 1998 annual report.
Yep.
It really captures their mindset perfectly. Let me read a bit of it. They wrote, "Such situations of crisis and panic that regularly affect the investors are our partners in the quest of our long-term objectives."
Partners. Interesting way to put it.
Isn't it? It continues. "To have good opportunities of enrichment, we therefore need a climate of pessimism that brings good businesses to prices well below their intrinsic value. The higher the pessimism and related market fluctuations, better are the opportunities to enrich ourselves." And then this kicker. So the next time someone asks you, does the stock correction affect you? You can answer, "Certainly, it improves my chances of getting richer."
That's quite a perspective. It really turns conventional thinking on its head.
It absolutely does. And it links straight back to Buffett's idea of having a good temperament towards market quotations. That's the key differentiator, they argue. Seeing opportunity in the panic.
That perspective really informs their expectations then. They even developed something called a rule of 3 based on past experiences. It sounds almost like setting expectations for bumps in the road. What are those 3 rules and how did they see them playing out?
All right, this rule of 3, they set it up after their really successful run from 2000 to 2002, basically to keep expectations grounded for themselves and their clients. Rule 1, they expect that in 1 out of every 3 years, the market will drop at least 10%.
Okay, so expect downturns.
Rule 2, 1 out of every 3 securities they buy will probably be disappointing. Not every pick works out.
Realistic.
And rule 3, 1 out of every 3 years, their own performance will likely be inferior to the indexes. They won't outperform every single year. They also pointed out it's not necessarily linear. We can experience 3 good years in a row and afterwards have 2, even 4 bad years in a row.
So it averages out over time, but the short term can be lumpy.
Exactly. And by 2007, they noted they'd actually underperformed the indexes for 3 of the previous 5 years. Yet, crucially, they stuck firmly to their core investment approach despite that. And digging into why they underperformed, they pointed to 2 major factors beyond just picking specific stocks. What were those, and how big a deal was that Canadian dollar again?
Right. What were the main drivers of that underperformance period?
Okay, the first factor was that the bull market leading up to 2007 was heavily concentrated in natural resources. Think energy stocks, they were up something like 250% from 2003 to 2007. And Giverny admitted they had very little participation in those soaring resource sectors.
Okay, so they missed that specific wave.
Right, and that contrasted sharply with the sectors where they did have investments, like financials and retail, which were struggling more at the time.
Makes sense. And the second factor, was it the currency again?
It was. The second, and they stressed this was critical, was the incredible rise of the Canadian currency. It went up over 53%, from about 65 U.S. cents in early 2003 to parity, $1 U.S. by the end of 2007.
53%? That's enormous.
Enormous. And it had a massive impact because, as we mentioned, about 90% of Giverny's assets are invested outside Canada. They gave this great theoretical example to illustrate.
Oh, yeah.
Imagine you invested $100,000 Canadian with them at the end of 2002. Over the next 5 years, the actual intrinsic value of the businesses they owned grew by 128%. That's an 18% annual growth rate. Pretty great.
Yeah, very strong.
And the market return of those holdings was 71%, so 11% annually. Still good. But when you translate that back into the much stronger Canadian dollar of late 2007, the actual return for the Canadian investor plummeted to just 15% total, or only 3% annually.
Wow. So the underlying businesses did great, the stocks did pretty well, but the currency move just wiped out most of the gain for Canadian investors.
Precisely. It shows how these external factors, like currency, can really mask the true operational performance you're achieving.
That currency effect is just so stark. Now, Giverny usually says they don't predict currencies, right? But they did do a special study here. What did they find about the Canadian dollar's actual, intrinsic value?
You're right. Their normal position is, don't bother predicting currency moves. They believe it tends to even out in the long run, stabilize against the U.S. dollar, have little overall effect. But their partners asked them to look into it specifically, given the huge run-up.
So what did they find?
They used the OECD's Purchasing Power Parities PPP as a guide. And that PPP data suggested the Canadian dollar's intrinsic value back then was probably around 81 to 82 U.S. cents.
So significantly lower than the parity it had reached.
Significantly. And they even backed this up with a little field study cited from the Journal de Montréal. It found that a shopping cart of goods was about 25% cheaper in the U.S. when the currency was at par. That really reinforces the PPP idea. Things were just way more expensive in Canada at parity. It was a neat practical check on the economic theory. So facing these challenges, particularly the currency headwind, Giverny was obviously looking ahead. What was their outlook for returns over the next 5 years, say from 2007 to 2012? And what factors went into those forecasts?
Yeah, how did they see things playing out from that point?
They focused on three main drivers for future returns. First, the continued long-term growth in the intrinsic value of the businesses they owned. Second, the market valuations, the PE ratios of their stocks. Were they cheap or expensive? And third, for their Canadian partners specifically, the level of the Canadian dollar. Would it stay at parity or revert?
All right, so business growth, valuation, and currency. Makes sense.
Based on those, they laid out three scenarios for the 2007-2012 period. The most cautious one predicted a 10% annual return. A second, sort of middle scenario, forecasted a 17% annual return. And the most optimistic one projected a 24% annual return.
24%, that's quite optimistic, especially coming off 2007.
It is. But their explicit conclusion, stated right there in the report, was that it's realistic to conclude that our securities can provide an annual return 17% per year by 2012. They lean towards that middle, still very strong scenario.
So they weren't just hoping for better returns, they were actively planning for them. What specific measures to improve returns were they talking about? Any strategic shifts, maybe geographically or into new industries?
Yeah, it definitely speaks to their confidence in the underlying value they saw. They really emphasized their commitment to continuous learning. They even quoted Charlie Munger on how Warren Buffett is a relentless learning machine.
Right. Always improving.
Exactly. So their plan was to actively open up to several other stock markets around the world, and also to discover potential investments in different, sometimes new industries. But crucially, while staying within their circle of competence, their areas of expertise.
So exploring, but carefully.
Right. It reinforced their core philosophy, always hunting for businesses with sustainable competitive advantages, wherever they might be.
So this sounds like a clear move beyond just being U.S. specialists, which maybe they had been seen as before. What did this global expansion actually look like in the portfolio?
That's a good point. Historically, they had relied heavily on the U.S. market. They felt its rigorous regulations often surfaced the best opportunities. At the time of the report, their portfolio was about 10% invested in Canadian businesses and another maybe 10% or so in clearly international businesses.
Okay.
But it's also worth noting, many of their big U.S. holdings, think Johnson & Johnson, American Express, Procter & Gamble, actually get a lot of their revenue from outside the U.S.
So they had some built-in international exposure already.
Exactly. Those companies actually benefited from the U.S. dollar weakness in 2007 because their foreign earnings translated back into more U.S. dollars. Still, they acknowledge Canada's market is relatively small, only about 3% of world market cap. The U.S. market is almost 15 times bigger, just a much larger pond to fish in.
Right.
So they mentioned recently buying 3 new businesses based in Quebec, and they pointed to past international investments in Hong Kong back in 1998, Australia in 2004, and Japan in 2007 with Notori, which we'll probably talk about later.
So a definite pattern of looking further afield.
Yes, and they even specifically mentioned being interested in the Irish stock market because they saw some very low PE ratios there at the time.
Interesting. So they're looking globally and also at new industries. You mentioned railroads, aggregate quarries, even solar energy. These seem a bit different from their usual holdings. What was driving that exploration?
Yeah, it shows their willingness to learn and adapt, even if they stick to their core principles. Let's take the railroad sector. They admitted they'd previously seen it as just too capital-intensive, maybe too cyclical.
Yeah, old school, heavy industry.
Right. But the success of Canadian National Railway apparently opened their eyes. They saw significant industry changes happening. Things like reduced operating costs, the efficiency gains from double-stacked wagons, better network optimization, and a big one, railroads having something like a 3 times fuel price advantage over trucking. That was becoming a major factor.
So the economics of the industry were shifting.
Definitely, making railroads look much more competitive, more profitable than perhaps they used to be.
Okay, what about the aggregate quarries? That sounds very down to earth.
Yeah.
Rocks and gravel.
Yeah, pretty fundamental stuff. With aggregate quarries, their insight was about logistics. As freight charges, trucking costs kept going up, the geographical location of a quarry becomes a really significant competitive advantage.
Proximity matters more.
Exactly. It's expensive to haul heavy stuff long distances.
Hmm.
So owning well-located quarries, like those run by Martin Marietta or Vulcan Materials, which they mentioned, becomes more valuable. They acknowledged the slowdown in residential construction was a headwind then,
Right. Less demand for building materials.
but they believe that planned investments in highway infrastructure, roads and bridges, should overcompensate for that dip in the long run.
Okay, long-term infrastructure play. Now, solar energy, that feels very different. High tech, maybe high risk.
It does feel different. They frame solar energy as an obvious alternative, given the world's need for new energy sources and, growing environmental awareness. They noted the high cost of traditional silicon solar panels, but they highlighted one company, First Solar, which was using a different thin film photovoltaic technology. The key there was potentially lower production costs.
So looking for a cost advantage.
Right. But they were also very cautious here. They acknowledged the market valuations for solar stocks were generally high at the time. And they made a really interesting comparison. Predicting the long-term winners in solar felt a bit like trying to predict the winners of the internet boom a decade earlier. Very difficult.
Yeah, lots of players. Hard to know who survives.
Exactly. So their strategy wasn't necessarily to bet on one specific solar panel maker. Instead, they were looking for potential indirect beneficiaries of the growth in solar.
Interesting approach. Less direct risk. Okay, one more sector they discussed. The Canadian oil sands in Alberta. Very significant, but also controversial. What was Giverny's take?
Yes, the oil sands in Alberta. They mentioned partners had recommended looking into it, and they were already monitoring the sector, partly through investments they held in energy service companies like Payson Systems. They certainly acknowledged the positives, the fabulous wealth being generated, the absolutely astronomical reserves, and the fact that exploitation was profitable at current oil prices.
But there sounds like a but coming.
There's definitely a but. They detailed the challenges very clearly, right from the report's perspective. They described it as requiring large amounts of capital, being technologically complex, and importantly, being a very polluting procedure.
Polluting how?
Specifically, high greenhouse effect gas GES production. They cited numbers suggesting oil sands GES emissions were 20–25% higher than conventional oil. And there was also a major wastewater disposal issue. It takes apparently 2 to 4 barrels of water to produce 1 barrel of oil from the sands. This had already led to the creation of 2 gigantic waste lakes, which was a significant environmental concern.
Wow, that's a lot of water. And the pollution aspect is key.
Very key. They also noted the U.S. Energy Independence and Security Act passed in 2007. That legislation had implications for importing fuels derived from more polluting sources, which could potentially impact oil sands. And on top of that, the Alberta government itself had recently increased the royalties extracted from oil sands production.
So environmental concerns, potential regulatory hurdles, higher costs.
Exactly. So despite the obvious growth prospects tied to high oil prices, Giverny concluded they would remain curious spectators. They felt there were just too many numerous possible unexpected circumstances, and the whole play was heavily reliant on sustained high crude oil prices. Too many variables, too much uncertainty for their liking.
Okay, that makes sense. Sticking to what they understand best. So we've covered the big picture, the strategy, the new areas they were exploring. Let's get into the nitty-gritty now. How did this philosophy translate into the specific companies they held? Let's shine a spotlight on some key holdings and how Giverny viewed their journeys in 2007. Maybe start with a big name. Walgreens, world's largest drugstore chain. What was the story there?
Right, Walgreens. They actually had a bit of a tough quarter in 2007, some issues with generic drug reimbursements, I think. But despite that hiccup, their overall earnings for the year were still up, maybe around 8%. The stock, however, took a significant hit.
Market overreacted, maybe?
That seemed to be Giverny's view. They focus on the fundamental strengths. Walgreens was still growing its store count, up to around 6,000 stores then. Their same-store sales were growing about 6%, which was actually pretty good given the retail slowdown starting. They had the highest prescription revenues in the industry, and really strong non-pharmacy sales too, about $282 per square foot, which is impressive.
So, solid underlying business.
Yeah. Giverny saw it as a fundamentally solid business, likely to grow earnings 12–14% annually long term. The stock price dip was seen more as an opportunity.
Okay, sticking with conviction despite a bad quarter, how about American Express? You mentioned it was their oldest holding since '95.
Yeah, Amex, a long-term relationship there.
Yeah.
Giverny mentioned they'd actually trimmed the position when the stock looked pricey in the past, and then bought back more after big events that hit the stock, like 9/11, or after Amex won a significant legal battle against Visa and MasterCard.
So actively managing the position based on valuation.
Exactly. They saw Amex as having the best brand of the financial industry and really liked its international growth potential. Now, in 2007, earnings growth did slow down a bit to 13% from maybe 18% previously. That was mostly due to the U.S. economic slowdown starting to bite, and they expected 2008 would be even tougher.
But they still held it.
They did. Their thinking was that Amex's customer base tends to have higher credit scores, which should offer some resilience in a downturn. Wall Street, though, was punishing the stock. Its P/E ratio had dropped to around 13 times earnings, compared to its historical average of maybe 18 to 20 times.
So again, seeing undervaluation relative to its quality and history.
Precisely. Classic Giverny looking for quality at a reasonable or even cheap price.
Okay, let's talk Disney. Everyone knows Disney. What was Giverny's history and thinking there?
Disney's an interesting one for them. They first invested way back in 1996, but they actually sold out completely in the early 2000s. Why? High valuation, plus they apparently had some discomfort with the executives running the company back then.
Interesting. So they pay attention to management quality, too.
Very much so. But then they bought back into Disney in 2005, specifically after Bob Iger took over as CEO. They clearly liked him better, and the results since Iger took over had been good. Earnings per share were up about 50% by 2007, but the stock price only up about 25% over that same period.
So the market wasn't fully recognizing the improved performance.
That was Giverny's take. They noted Disney's price-to-cash flow ratio was at a 15-year low, just 10 times cash flow, or 14 times earnings. Their summary was, magnificent business, an exceptional CEO, and an attractive valuation. Ticked all their boxes.
Great example of their value approach. Okay, moving to a different sector. O'Reilly Automotive, the auto parts retailer. How did that fit in?
O'Reilly Automotive. In 2007, their revenues were up 11%, earnings up 9%. Pretty solid. Giverny considered it the best business in this sector. They really praised the leadership and their operational discipline.
What kind of discipline?
Well, even though the retail environment was slowing down, O'Reilly kept investing for the future. They planned to open 200 new stores in 2008, kept spending on advertising, focused on customer service. They didn't pull back. And the numbers showed the long-term success. EPS had grown 82% total between 2003 and 2007. That's 16% annually. But again, the stock price hadn't kept pace, only up 40% over that period.
Another disconnect between business performance and stock performance.
Exactly. Its P/E ratio was around 17 times, below its average of 21 times. Giverny believed it was undervalued and had the potential to double its intrinsic value in maybe 5 or 6 years. Patience required, again.
Seems to be a theme. Okay, what about Brown & Brown, an insurance brokerage that had a tougher 2007?
Right, Brown & Brown, or B&B. 2007 was definitely more difficult for them. Earnings were up only 10%, which is well below their usual growth rate of around 25%.
What caused the slowdown?
The report pinpointed a specific issue in Florida. The state-run Citizens Insurance started offering deeply discounted property insurance, which directly impacted B&B's revenues in that key market. Giverny's view, though, was that this situation was likely temporary, a distortion, not a permanent problem.
So they looked past the short-term hit?
They did.
Yeah.
Despite those issues, they still considered B&B the best business in the sector. Why? High profit margins, excellent management, and lots of potential for growth through consolidating smaller competitors. Another case of backing quality through a rough patch.
Okay, how about a Canadian company, MTY Food, Inc., Quebec-based restaurant franchisor? What was the attraction there?
MTY Food, Inc. They highlighted it as a leader in fast food franchising in Quebec, running about 809 restaurants across 19 different banners at the time. The key attractions were that it was profitable and growing very quickly, around 30% per year. And, something Giverny clearly values, the president, Stanley Moe, owned a significant chunk of the company himself, 26%, and drew what they considered a reasonable salary, owner-operator alignment.
Got it. Alignment of interests. Now, Bank of the Ozarks, a regional U.S. bank. Banks were getting scary in 2007. How did this one look?
Yeah, Bank of the Ozarks, based in Arkansas. Their earnings per share were actually stable in 2007, which was pretty good considering the yield curve was flat, making it tough for banks to make money. Giverny noted a recent Fed rate cut suggested 2008 might actually be more profitable for them. But the crucial point, Bank of the Ozarks hadn't taken any reserves for subprime loan losses.
Not at all.
Because, according to Giverny, they were just very conservative in their lending practices. They hadn't made those risky loans in the first place. And again, alignment. The CEO, George Gleason, owned 23% of the bank's shares. He had skin in the game.
So conservatism paid off there.
It seems so. Giverny admitted the investment had been disappointing up to that point, mainly because they'd paid a higher than usual PE ratio for the shares. But they held on, believing it was an excellent bank, and sticking to their principle that sometimes avoiding an exceptional business just because the price is slightly high can be a mistake in the long run.
Interesting balance there. Okay. Night transport. Trucking, notoriously tough, cyclical business. What was the rationale?
Night transport, yeah, trucking. 2007 was difficult for them too. EPS was down 12%, but that was pretty much an industry-wide problem. Despite the cyclical downturn, Giverny viewed Knight as an exceptionally well-managed business in a difficult sector.
So, best house in a tough neighborhood kind of thing.
Kind of, yeah. They expected the company would be rewarded when the trucking cycle eventually recovered. They also liked its strong balance sheet, which gave it potential to make acquisitions of weaker competitors during the downturn. And again, management owned about a third of the shares. That owner alignment theme keeps popping up.
It really does. Okay, Microsoft. Huge tech name. What was their 2007 story?
Microsoft actually had a pretty remarkable 2007, according to the report. The release of Windows Vista was deemed a huge success. Their EPS jumped 33%, and the stock was up 20%.
Pretty good year then.
Yes, but then the stock dropped in early 2008 after Microsoft made an offer to buy Yahoo. And Yahoo refused it. The market didn't like that uncertainty, given Andy's view. They thought Microsoft was probably worth around $40 per share. But after that drop, it was trading at a PE ratio of only 14 times earnings.
Which they saw as low for Microsoft.
Definitely. They saw significant undervaluation there, even for a giant company.
Okay, let's go international again. Nitori, the Japanese retailer. What was compelling about them?
Nitori. They're a Japanese home furnishings retailer, kind of like IKEA. What was impressive was their growth. Despite the fact that Japanese retail overall was pretty stagnant at the time, Nitori's net income was up 18%, and their return on equity was a healthy 17%.
How are they managing that?
One factor mentioned was they benefited from the rising Japanese yen because they bought a lot of their goods in China, paying in cheaper currency, and sold them domestically in Japan, earning in stronger yen. Plus, the CEO, Akio Nitori, who still ran the company brilliantly apparently, owned 12% himself. They had plans to open 20 new stores annually and expected EPS growth in the 15–20% range. Just a solid growth story in a tough market.
Finding gems overseas. All right, Johnson & Johnson. Healthcare giant, considered pretty defensive usually. How was their 2007?
Johnson & Johnson J&J had an excellent 2007. Revenues were up 15%. That was partly helped by an acquisition from Pfizer and also by the weakness of the U.S. dollar boosting their large international sales. EPS was up a solid 10%.
Steady Eddie.
Pretty much. They did expect growth to slow a bit in 2008, maybe around 7%, because they were losing patent exclusivity on a big drug, risperidone. But Giverny viewed J&J as one of the best healthcare companies around, almost immune to economic cycles. And the valuation looked attractive again, trading at 14 times earnings, whereas its 10-year average PE had been closer to 25 times. Another case of perceived undervaluation for a quality name.
Okay, Morningstar. Financial information services. This feels very much in Giverny's wheelhouse.
Absolutely. They acquired Morningstar shares in the spring of 2007. They really admired the company's financial information services, its long-term vision, and particularly its focus on analyzing competitive advantages, something Giverny themselves care a lot about.
Right, the moat concept.
Exactly. And they loved the CEO and founder, Joe Mansueto. Get this. His annual salary was just $100,000. With no bonus and no stock options.
Really? For the CEO of Morningstar?
Yep. And he owns 68% of the company. Talk about alignment.
Wow, that's incredible alignment.
Isn't it? And the business was performing incredibly well, too. 2007 revenues were up 37%, EPS up 40%. Giverny called it one of their most profitable businesses. Fit their mold perfectly.
Owner, operator, competitive moat, strong growth, reasonable valuation. Checks all the boxes. Okay, last one from the portfolio spotlight, Fastenal. Held for nearly a decade. What's the lesson there?
Fastenal, industrial supplies distributor. They apparently just ignored the economic slowdown that was starting. Profits were up 17% in 2007, and the long-term picture was amazing. Since Giverny first bought shares nearly 10 years prior, Fastenal's EPS had grown from 35 cents to $1.85. That's 18% compounded annually. And the SOC, up 700% over that time.
Incredible compounding.
Incredible. But Giverny also acknowledged there were periods within that decade where the stock went nowhere. They specifically mentioned 2000 to 2003 when the stock basically stagnated. Their belief was patience gets rewarded eventually if the business fundamentals are strong. They expected Fastenal's patience would pay off again. It's really the poster child for their long-term, buy and hold, quality-focused approach. What's really striking about this report, and Giverny in general, is how open they are about things that didn't go well. They actually dedicate a whole section to their mistakes du jour, mistakes of the day.
Yeah, that's pretty unusual in annual reports.
It really is. They award themselves medals for their errors. What were the top ones for 2007? And more importantly, what did they learn from them? They frame it with a constructive attitude, hoping to always become better investors.
Okay, let's hear about the mistakes. Start with the bronze medal. What was that for?
The bronze went to Garmin, the GPS maker. And this was a mistake of omission, a missed opportunity. They'd actually looked closely at investing in Garmin back in 2004. It was already a leader in GPS devices.
So why didn't they buy it?
Their main worry was about Garmin's very high profit margins, 43% at the time. They thought those margins might not be sustainable. They worried that as volumes increased, the GPS market might become commoditized, driving prices and margins down.
A reasonable concern, perhaps.
It was. And margins did come down eventually to around 37%. But what they missed was that the sheer growth in revenue, the volume explosion, more than compensated for that margin pressure.
The growth overwhelmed the margin decline.
Exactly. The outcome. Garmin's earnings per share tripled between 2004 and 2007, and the stock tripled too, even accounting for a big 50% drop it had recently experienced. The lesson Giverny took away. Sometimes, really strong revenue growth can offset margin pressure. Their inherent caution perhaps made them miss that upside.
Okay, a missed opportunity. What about the silver medal? This one sounds like an actual investment that went wrong. W.P. Stewart.
Oh, this one definitely stung. W.P. Stewart was an asset management firm, actually with a very similar investment philosophy to Giverny's. They'd done very well for their clients for decades.
Sounds like a good fit on paper.
It did. But the firm's performance started to slip between 2002 and 2007, lagging behind the S&P 500. Then came the major problem. Key employees started leaving, and they took client assets with them. W.P. Stewart ended up losing over half its clientele. Revenues dropped by half, and by 2007, earnings were close to zero.
Ouch. That's a collapse.
A serious collapse.
Yeah.
The result for Giverny modest, an 80% loss on what had been a 4% position in their portfolio. Even accounting for dividends, it was a net 3% capital loss overall. They explicitly called it their worst loss ever.
Wow. So what went wrong in their analysis?
Interestingly, they felt their actual analysis of the company was sound. They understood the business model, the history. What they admitted they underestimated was, 1, how impatient clients could be with underperformance, especially healthy clients. 2, the pressure from financial intermediaries recommending clients pull money out. And 3, the strong allure of hedge funds at the time, which were attracting assets away from traditional managers. They thought W.P. Stewart's problems were temporary, just a rough patch. But, as they put it bluntly, we were wrong.
Humbling.
Very. The lesson was clear. Acknowledge when you're wrong, learn from it, and accept that occasional unsuccessful investments are just part of the business. You can't win them all.
Powerful lesson. Okay, bring home the gold medal for mistakes. This was Shoppers Drug Mart, another missed opportunity.
Yes. The gold went to Shoppers Drug Mart, SDM, Canada's big pharmacy chain. Another one that got away. They said they'd followed SDM for years, even back when it was part of a Moscow, a conglomerate. They knew its potential when it went public as a standalone company in 2001. At the IPO, its earnings per share were $0.41, which Giverny felt did not reflect the true earning power of the franchise.
So they thought it was better than the numbers suggested.
Yes, and they admitted in hindsight, we should have disregarded the high PE of the stock at the time. They let the initial high valuation scare them off. Then, in 2003, they invested in Walgreens instead, believing the U.S. chain had higher long-term growth prospects. They also observed that a competitor, Jean Coutu, was having difficulties expanding in the U.S., which actually created more opportunity for SDM within Canada, particularly in Quebec.
So what was the mistake then if they bought Walgreens?
Their stated mistake was, investing in Walgreens should not have prevented us from investing in SDM as well. They saw it as an either when it could have been both hand. They particularly missed how well SDM executed on improving its profit margins, especially through the success of its private label brand.
Wow, they underestimated the margin improvement story.
Exactly. The outcome. By 2007, Shoppers Drug Mart was earning $2.28 share, more than 5 times its 2001 earnings. And the stock was trading at $51. Giverny calculated they would have tripled our money in an investment where the risk was very small. A huge opportunity missed.
Another painful lesson in omission. The willingness to just lay these out, analyze them, admit we were wrong, that's really impressive. It speaks volumes about their culture of learning. Like that Conrad Hilton quote you mentioned, successful people keep moving, they make mistakes, but they don't quit. It's fascinating that a firm with their track record is still so focused on dissecting what they could have done better.
Absolutely. That transparency and commitment to learning is a real hallmark, and it connects directly to their concluding message in the report. Despite the tough year, despite the mistakes, they end on a note of clear conviction and optimism. What's their ultimate takeaway about owning stocks long term? And what do they see as the essential ingredients for success, especially when markets get volatile like they were then?
Yeah, what's the final word from them?
They emphatically state their belief that owning stocks is the best wealth creator in our capitalist world, period. They point to the long history of equities returning around 10% per year, and of course their own even better experience since 1993. But, and this is crucial, they stress that the price to pay for better returns is to live with fluctuations. You don't get the reward without the volatility.
No free lunch.
No free lunch.
Yeah.
And the other essential ingredient they highlight is patience. They call patience the catalyst to make it through difficult times. Temperament and patience.
So embrace the fluctuations, be patient. They were clearly bracing for more tough times, too, possibly a recession in 2008. How did they frame recessions, and why did they sound so upbeat about their specific portfolio right then?
Yeah, they didn't shy away from the possibility of recession. Their stance was direct. If there is a recession in 2008, we are ready.
Confident?
Confident. Their historical view is that North American recessions, while unpleasant, have always been temporary. And more than that, recessions have always represented incredible opportunities to buy shares from solid companies at great prices. Back to that theme of crisis equals opportunity.
So they see downturns as buying opportunities.
Exactly. They explicitly say they don't believe in trying to time purchases perfectly, as the market usually drops before a recession is officially declared and starts climbing before the recovery is obvious. Trying to time it is a fool's errand.
Right, time in the market, not timing the market.
That's the essence. They felt the businesses they currently owned had good balance sheets. Strong companies would actually profit from a slowdown by gaining market share from weaker rivals or by making acquisitions on the cheap. Plus, many of their companies could use their cash flow to repurchase their own stock at depressed prices, further enhancing long-term value.
So turning a negative into a positive.
That's the perspective.
Yeah.
And it led to their final burst of optimism. They concluded that their current group of businesses was the most solid we ever owned. And at the same time, their market valuations had never been so low. Solid companies, low prices. That combination made them very enthusiastic about the long-term return prospects from that point forward.
That really brings us full circle. We've journeyed through Giverny Capital's 2007, a tough year by the numbers, but a masterclass in perspective. What really stands out is that unwavering belief in owning quality businesses for the long haul, the absolute necessity of the right temperament and patience, especially when markets are rough, and this really proactive, almost humble dedication to learning from every experience, maybe especially the mistakes.
Absolutely. Giverny Capital's 2007 report offers such a fascinating lens on how truly long-term investors process market turmoil and uncertainty. It leaves you with a thought, doesn't it? As you reflect on their journey through that challenging year, their focus on intrinsic value, their cautious steps into global markets, that radical transparency about mistakes, what does it teach you about building resilience in your own financial life, especially when you inevitably face those market ups and downs?